Today, folks, the sad reality is you and I are far too broke to go bearish on this market. Whether all-time highs, correctional lows, I'll be cost averaging by the graces of God, taking me to the holy promised land of financial independence to pray one day retire early. Whereas these billionaires, they don't have to worry about that. They have other things to worry about. They got your money to worry about, billion-dollar companies and making themselves rich. But we've recently seen the likes of Berkshire's Warren Buffett liquidate half his Apple position this year to bank a record cash of $325 billion. You know this guy? Everyone's talking about this guy right now, but no one was really discussing the fact that going into the beginning of the year into spring, this guy sold $370 million worth of his stock. Michael Saylor, the Bitcoin evangelist, literally selling MicroStrategy, the company that he runs, banking like over $250 million. And he literally missed the ultimate pump to over 90K when MicroStrategy went to the moon. But does he care? The guy banked over $250 million. I don't think he lost in that transaction. You look at things like Alex Karp from Palantir. You know, this thing's been going to the moon and back, and through November here, we've seen him sell $73.1 million worth of shares. These people are absolutely loaded now, and these people are in the position where they can say, hey, I'm going to go bearish on the market. I'll just leave 10 million in the S&P, and, you know, I'll keep maybe 60 million cash. I'll be good. I know my family will be fine. Like, these guys are playing at a whole different level compared to us brokies. It's crazy to think that even having $1 million, you're still kind of broke. You're not playing this level of insanity, right? But that does not stop me from buying stocks. Obviously, you're going to read these headlines, and I've been trying to give you guys really educational videos to help you navigate when we get into market cycles like this, because they're more or less momentum FOMO like markets. I'm going to explain to you how I know that is pretty much a fact at this point. But you take a look at like my portfolio today alone. You know, it's Turkey Day in the United States, so I had only an option to buy Canadian stocks. US markets are closed. I bought VDY. I bought a little bit more, right? I'm going to be buying a little bit more Google here very shortly as well. And I'm very thankful that SCHD continues to take me to the moon, as I have over 100,000 in my RRSP. Very beautiful. Muy bien. It's great to see. But all of this is in line in a very weird way. VDY, SCHD, VOO, dramatically different holdings, yet all these stocks are raising in the same fashion. And I don't know if this is because of the interest rate cuts. I don't know if there's some underlying cycle going on here, but it's very peculiar that just in the last 6 months, somewhere right around here, everything decided to start performing in a very similar way, with the exception of the Qs. Like if we just remove the Qs, look at how in line the performance has been here. It's been so similar. And in fact, we've actually seen VDY and SCHD actually pacing better than the S&P 500's been. You were better off 6 months ago buying these two dividend ETFs than you would have the S&P. That's not going to remain true in the future because obviously if we zoom out, the S&P has performed dramatically better. But still, there's something really weird going on here that I find very interesting. Now, this all boils down to me wanting to break down these ETFs to take a look at the price to earnings multiples. I want to show you kind of the cash flow they're generating today to get an idea of if this market truly is overvalued, what does it mean for the broader ETFs, and so much more in between. So if you are on a path to financial independence, if you damn well one day want to retire early, join me, hit that subscribe. And if you like my portfolio tracker, which today my portfolio is doing nothing because the US markets are basically closed, Canadian markets barely move, it's the smallest piece of my portfolio, you can go actually get this portfolio tracker over at kylelivingston.com. The link is in the description below, where I separated out everything I was selling so you guys can buy everything from one-on-one to my WhatsApp group where we have 7-figure investors to even my spreadsheet tools. So go check it out if you want to support the channel. Now, before we break down the actual ETFs themselves, because a lot of people have been asking me, like, what's the value of these ETFs? You know, does it matter? And I think it's really intriguing, the data. But if we take a look at what's kind of moving the markets, it's really, really peculiar, because I have a prediction that as they cut interest rates, it's going to raise the lower half of the market, because those are more infrastructure, those dividend stocks, they tend to have more debt on the balance sheet and it would increase cash flow. And now that we're starting to see interest rate cuts, we're still seeing a lot of spatter movement. It's not saying that you know, isn't going to come into fruition, but look at this. Like Microsoft is only up 2% over the last 6 months, yet Apple's up 22%, Walmart's up 41%, JP Morgan up 25%. So you're seeing like a really odd spattered performance in almost every sector of the market in the United States. And the same can roughly be said for the Canadian markets as well. I mean, energy at a time where energy shouldn't be doing well, oil's been down. A lot of energy stocks are doing great. The banks in Canada, the financials doing great. I mean, Shopify's up almost 100%. Industrial's getting hit. Basic materials, mixed bag. Like, it's just such a weird market. You can't just point to any one sector right now and say this is what's causing all the growth. Now, if we take a look at the components, we're going to start with VDY because VDY is just very interesting. And I'm going to explain to you why people think the Canadian markets will outpace the US markets next year. Firstly, we have a price to earnings ratio of 14.9, which is the lowest of pretty much any ETF we're going to look at. The return on basically equity is about 12.4 with a price to book, which is interesting. This is like the net asset value. So the price of the stock versus the underlying value of the actual companies themselves, something we talk about with REITs and other companies, but it's only 1.7. It's almost like it's very low. 1.7 is insanely low, but the earnings growth rate, and this we're going to pay attention, the earnings growth rate is only 4.2%. And I wish they would tell me, is that based on this year? Is it over the last 5 years? They don't really give enough insight because something tells me it should be a bit higher than that, but it's low. I mean, we don't get a lot of earnings growth in Canada compared to the United States, but still, this is a very modest ETF that gives you my favorite weightings in the banks to Enbridge, Energy, all that stuff, right? Very well weighted. But if we compare it to say something like SCHD, the US dividend ETF that I like, that I hold in my RSP, the price to earnings ratio on this one is 17.58. So it's slightly higher by 2 or 3 percentage points, or 2 or 3 points over VDY. The price to book's 3.26, over double, right? And then you take a look at the price to cash flow ratios, 10.27. Return on equity is about 28.24, and the 5-year earnings growth is 9.68. And these are with companies like Home Depot, Verizon, BlackRock. But the 5-year earnings growth rate is, again, I really like to see that for VDY because, you know, that's more modest in my opinion. That's what we're looking to achieve. That anywhere between 8 to 12% is the Goldilocks era, I think. I think it's just a healthy place to be in a portfolio. But we're getting exceptionally high rates of return off the S&P, and this is why I still continue to focus on VOO, making it half my portfolio, because people don't understand that. How does this go up so aggressively? Well, the earnings growth is at 18.8%. That is absolutely insane. And again, I'd like to know if this is over 5 years, is this within the last year? It'd be great to get more clerical view on that. And we can see the price to earnings is 26.9, which actually isn't that bad. Keep in mind, this is based off 10/31/24. So, I mean, we're at the end of November now into December. So, I mean, this is outdated by like a month or two. But honestly, for an 18%, if that's compounded year over year, a 26 times multiple is not that high to pay. It's important to understand the price to earnings is basically like, if the company doesn't grow at all, it's going to take 26 years for me to get a full rate of return. And it'd be really bad if earnings go down because, you know, then all of a sudden this number continues to go up. And 26 years is a long time to get all my money back. But if we're growing at, you know, almost double a 10% return, like you go to 20% return annualized, yeah, that's you know, I have no problem paying a 20 times multiple for that, right? So you start to understand the valuations here aren't like absolutely insane. You got a price to book ratio of 4.7, right? So keep in mind the price to book is 3.26 for SCHD, and for VDY it's 1.7. So we're still paying a hefty premium for these stocks. They're not like, I don't think it's that insane from my personal opinion until we look at like the QQQ ETF. And this is where like I get an understanding of why, when it comes to technology specifically, and it comes to, you know, Berkshire selling Apple, perhaps Alex Karp taking profit on Palantir or selling out of Bitcoin. I just feel like there's a lot of FOMO right now in technology because of AI, and you see it in these valuations. But we can see the price to book on Qs are at 16, and the price to earnings ratio is at 37, which historically is closer to 30, I believe, for this company. So I'm very intrigued because as we break down a little bit more, I mean, just take a look again, the price to book, just take the 16 into consideration against VOO that has a price to book of 4.7, SCHD that has a price to book here of 3.26, and again, VDY at 1.7, right? So you can start getting an understanding that these valuations are very, very high in this ETF. And if we take a look at the current holdings, I mean, we're talking about Apple, Nvidia, Microsoft, Amazon, Meta, Broadcom, you know, Tesla's, Costco, all these companies in here. I can really only point to two that I would say are materially cheap. And one, like Google's very cheap and comparable, and Meta. Otherwise, I don't think any of these are particularly cheap. With the exception of the growth that Nvidia might have if it continues to keep up those kind of growth rates, right? Now, the reason I'm talking about this is not to scare you away from buying tech companies. In fact, this is still, I think we're in a technological revolution, but there's gonna be a lot of volatility that comes with that. And I just want to get an understanding of what they call an all-weather portfolio. And I've been really hammering asset allocation, sector allocation, because what ends up happening in a market environment like this is you're seeing people get absolutely just conglomerately rich because they're taking profits to diversify their holdings, to take some risk off the table. And it's really healthy to do so, because the fact is if I want to hold individual stocks, I don't weight any one more than 5%. And let's say that stock does what it's been doing in this market environment, it goes up 500%. That 5% weighting is quickly going to become 10, 20% of your portfolio, right? But in other market environments where, let's say, we end up seeing a sell-off, a correctional period, we might see a lot of those tech companies get hit. But in the meantime, at least I know my dividend stocks, my infrastructure companies, they're going to keep paying me a yield. They're not going to get hit nearly as hard in a bear market, and I can use that cash to reinvest. So you kind of get the best of everything, right? Because it doesn't take a lot in a speculative company to get a massive rate of return. So you don't want to overset your portfolio, because again, volatility goes both ways. Either it goes insane returns or insane losses. So I'm just trying to get you to stomach and adjust to what a healthy portfolio at scale looks like. And if you want to see more of how I manage the wife and I's portfolio, my parents' portfolio, I do pull back the veil over on my courses that you can get over at kylelivingston.com as well. But I do want to pass a question off to you. I'd love to know what you think in that comment section below.